Welcome back. We are busy with Class 7 investments. We are now looking at Unit 3.3 investment trusts. So we'll discuss what exactly is an investment trust. An investment trusts are holding companies that makes their shares accessible to be traded on the Johannesburg Stock Exchange. Investment trusts differ from collective investment schemes in the following ways. They are available through a holding company. Financial institutions offer collective investment schemes. The costs are lower. Trading is done only through a stockbroker, not a financial intermediary or a holding company. They are controlled by the Companies Act, not the Collective Investment Schemes Controls Act. Investment trust values are quoted on the JSE Limited. Collective investment schemes are not. Investment trusts are classed as closed-end funds. It means there is a limit to the number of shares available, and invariably there has to be a willing seller for an investor to buy shares. Collective investment schemes are open-ended. There's no limit to the number of shares available as the investor's money is used to purchase more securities. No limitations are placed on the holdings. Both listed and unlisted shares can be held in any quantity, and all proceeds and distributions are paid as dividends out of after-tax income. There is no interest portion as with a collective investment scheme that pays the pre-tax investor income. Investment trusts offer the same diversity and accessibility to different securities as collective investment schemes. However, they are more flexible in that they are not governed as strictly as collective investment schemes. The costs are also lower as no initial charges are levied. However, when buying investment trusts via the JSE Limited, normal brokerage and compulsory charges will have to be paid. Investment trusts can invest in several listed and unlisted securities. An investment trust is a listed company and have shares, and their shares are traded on JSE Limited. Shareholders do not have rights over the holding company's assets, and all securities are held in the name of the trust. The holding company is obliged to hold an annual general meeting of shareholders to adopt the company's financial reports. The trust is closed-ended, so an investor must have a seller to buy shares. The holding company offers no guarantee on the buyback of shares, and the price of shares directly results from demand and supply. The proceeds from stock sales are used to buy securities of other firms. The only way shares in issue can grow is through a rights issue. Existing shareholders have the first right to buy the newly issued shares, and those not taken up are then offered to the general public. The share price does not mirror the underlying value of the investment trust. Shares can trade at a discount or premium to the next asset value. The fact that the price of the investment trust differs from its net asset value introduces an added source of risk and potential return. The net asset value is calculated by aggregating the market value of the individual shares and securities held by the trust and then dividing by the number of shares issued. Due to their nature, collective investment schemes are not allowed to borrow money or write future contracts. Investment trusts can raise capital through the issuing of ordinary shares and by taking on debt. They can borrow by raising a commercial loan. Borrowing, however, increases the portfolio's risk and the skill of the portfolio management needs. Some years ago, investment trusts made the investments available through a share plan whereby an individual could invest a regular amount into the trust, much like a monthly plan placed with a collective investment scheme manager. However, the tax authorities refused to apply capital gains tax for investment trusts in the same way as they would apply it to the unit trusts. What this meant in effect was that investors in investment trusts paid capital gains tax twice. The trust was taxed on the capital profit it made in its portfolio, and the investor paid tax on the capital gain it made when it sold the units. Collective investment schemes do not pay capital gains tax on the gains made in their portfolio. Instead, the investor pays capital gains tax when he realizes his units. It is therefore not surprising that investment trusts have all but disappeared from the South African investment scene. They are still prevalent in the United Kingdom. However, because they can borrow, use derivatives, and are less regulated, they are generally considered riskier than collective equity investments. In recent years, many investors suffered massive losses of capital in investment trusts. Investment trusts are no longer quoted as a separate sector on the JSE Limited. However, some companies hold a diversified portfolio of significant companies that give broad exposure to the South African economy and market. An example would be a share like Remgro, which is listed in the diversified industry sector. Often such companies trade at a significant discount to the net asset value and can offer investors an attractive entry into a professionally and actively managed portfolio of companies. That concludes our session on investment trusts. The next session we will look at is guaranteed products, which is unit 3.4. So I'll see you when we start our next session on guaranteed products. Thank you.